Hello and good afternoon. I welcome you to today's Trading Spotlight webinar here together with Admiral Markets. It's Friday, it's the 11th of December, so it's only 2 weeks to go till Christmas. And so perfect time then to get a topic here, come up with a topic with I'm sorry. Yeah, I just see here within the chat box the question: what is the Santa Claus Rally? Yeah, this is exactly the question we want to answer today's webinar. So we want to today shine a light on a classic seasonal pattern, in fact, which occurs over and over again, and which now we want to give some further thoughts, some further details on, in fact, define it, and also give some stats on how it worked over the last couple of years, in fact. And there's, in fact, some analysts out there and also traders who trade this very successfully, and also who are running websites around Santa Claus and respectively the Santa Claus Rally, not around Santa Claus. And this is exactly what we want to dig deeper into today then. And this is, in fact, the follow-up, we can call this, from last week's webinar when we looked at seasonals in commodities, especially. Remember, we had we shed a light on gold here, a seasonality which occurs usually between November and January. December, probably December, mid-December to mid-January. We also had a look on wheat, for example. We also gave some thoughts on forex, especially. And so today we want to then look at Santa Claus and the Santa Claus Rally, in fact. And here is today's agenda. So what we want to look at today is what is the Santa Claus Rally. So this will be the first bullet point here, and will be the first the definition behind this, in fact, and answer the question in the chat box I just received. Then we also want to show the Santa Claus Rally graphically, and then we want to understand the Santa Claus Rally. So understanding means, in this context, what are the potential drivers? Does this make sense, or it's just a coincidence that it happens over and over again? And we want to give an idea on the fundamental drivers, which are really there. And then, certainly we will also look at the pros and cons of trading the Santa Claus Rally. So there's, in fact, some traders out there, or analysts, researchers, who doubt that there's really such a real fundamental driver behind this. It's more like coincidence. But at the end, we will see that the Santa Claus Rally is not just something you can measure, but based on the measurement, you can also formulate trading setups around this. And so before we start, first of all, let's have a look here at my person. First of all, no, let's have a look here. Yes, this is true. This is true. This is who Santa Claus is. But now the question is, where does the rally in equity markets result from? Someone writes, Ronald writes, he's a famous person from the North Pole. He gives presents at Christmas. And if you have children, by the way, you'd be surprised what smart questions these children really can ask around Santa Claus. But that's not today's topic. So first of all, around my person. So my name is Jens. I'm located in Berlin, in Germany, and I'm in the financial industry now for around nearly 20 years, around slightly below that, probably it's 16, 17, something like that. And I entered the world of finance as a trainee in a bank, in fact, after I finished school. And then from there, I found out quite quickly that trading is where I wanted to be, especially this world of adrenaline, of fast money, fast cars, beautiful women, in fact. So some of you might laugh now, but in your early 20s, as a guy full of testosterone, you think exactly that way. And that was my main intention, in fact, why I got started in trading, or respectively, why I wanted to start out as a trader. And shortly after, I realized that you have to have a university degree to get into an investment bank, respectively, to gain momentum on Wall Street, in fact, and most likely, especially in the quantitative space. And so I studied mathematics. I, beside that, had to finance my studies, because if you worked in a bank and if you made money on your own and you, you just tasted the sweetness of being financially independent from your parents, especially, and you go to university, then you have to find a job. And I was all the time very, how can I say that? I was very, very optimized, let's call it, in this context. So what I wanted to make sure was that my job is not just a job I do to make money, but also I can learn something from. And back then, my girlfriend, my father had someone who worked for a stockbroker. He introduced me to that guy. And so I landed my first job at a stockbroker, in fact, at a professional trading desk. And this is where I learned how to trade, in fact. So I'm really where I learned the basics. And so, yeah, took it from there then. So the world of positive or expected value and expected value optimization, in fact, was part of my life from there on. Then when I started playing poker, beside that, there was the online poker boom. Some of you probably have seen that or know about that. You could also make some money trading, not just trading the markets, but also by playing online poker. And back then, I had some colleagues who introduced me to that world, also made some money there too to finance my studies, and then so on and so forth. And the interview here around my vita and where I started, how I started, especially in trading, about my first trades I made and the first bad experience I made there, you can find it in the description box of this video here below. An interview I did together with Admiral Markets, the broker behind this Trading Spotlight webinar series. That's probably of more interest here. Because Admiral Markets is most likely one of the most competitive and one of the most recognized brokers in the CFD and FX industry, in the world of financial service providers with highly competitive offering, especially when it comes to DAX trading. Some of you might not be aware of that, but here in Germany, we refer to Admiral usually as the DAX expert with the most competitive offering on DAX trading. Beside that, you will also find out, probably you remember a webinar we did several weeks ago on the broker business model, respectively, on the conditions and where a broker makes money. And here in this context, I pointed out the highly competitive offering also in the FX space Admiral is giving to retail clients. So long thing short, admiralmarkets.com, just check out the website for further details. Here in Germany, as I already said, Admiral is one of the most known and also one of the well-established brokers, in fact, in the FX and CFD industry. And yeah, is here the host of this webinar, in fact, and I have the chance to give a webinar here together with Admiral Markets today on this topic, the Santa Claus Rally, and the rally we want to introduce right now. We want to define. So first of all, the question, what is Santa Claus, respectively, what is Santa Claus, the Santa Claus Rally? So Santa Claus Rally is referring to the tendency for the stock market to rally over the last week of December into the new year. So this is very interesting right now. So some of you might have heard about Santa Claus Rally, and probably today in the DAX, especially with this drop back towards 13,000 points. So if you have the chart open, if you just check the screen, I think the quite heavy bounce against the September highs around 13,450 points. I think that's we're we have much difficulties now to really see a rally into the Christmas days. In fact, some I would have expected, let's put it that way, once we take out especially 13,450 points, that it would make it very likely that the DAX has potential up to its yearly and thus hits all-time highs around 13,800 points. But the interesting thing about this is not what the Santa Claus Rally is referring to. In fact, Santa Claus Rally is focusing, in fact, on the days after Christmas and into the first days of January. So we are, in fact, see a start of this rally. So here in Germany, for example, by the way, very important, in fact, when you're trading the DAX. in our case, it's not just the 25th where the markets are closed, as in the US equity markets, S&P 500, Dow Jones, NASDAQ, all these markets are closed on the 25th, but on the 26th, markets are open. You can trade. This is just shortened trading hours, but all in all, you have a chance to trade US equity markets. In case of the DAX, it's not possible. 26th, the market is closed. By the way, I just have to check up whether that's probably weekend, but I don't think so. Oh, it's a weekend. I'm sorry. Okay, 25th. It's a prolonged weekend. 26th this year is a Saturday. But if it was a Friday, in this case, there would have been no trading taking place. In fact, here in Germany in the DAX, while U.S. equity markets are open. So when we look at the DAX, the Santa Claus window, let's call it, we are usually referring to the 26th, 27th, 28th, 29th. And 30th, while the 31st of December markets are closed. It's a very thin market environment. So this is something we have to really remember in this context. So be aware of the fact that there's usually, this is a window, we will find it out quite soon. You can profitably trade in, but the volume you can trade within this window is limited because, or due to low, not just low volatility, but also due to the fact that most market participants are already on vacation and are not really participating within the market, which is then meaning that if there's a market participant, for example, who is dumping a big position in whichever market we are looking at here, especially probably in the DAX, we have chances of a high drop, or a sharp drop, in fact. So big slippage opportunities arise, negative slippage, especially when it comes to hitting your stop loss. This is something you have to take into account. So it's not a no-brainer trade where you just go long and then pick up the dollars from the street, which are falling, I don't know, from a yeah, whatever, from a train or something. But it's something where you have to really also take the risk into account and the low volatility and the low volume environment you find yourself in. And now we want to here now look at, one second, where I have the mouse, sorry. There we go. The thing is that it's not 100% clear, coming back to the Santa Claus Rally, why it exists, in fact. So there's several reasons which are mentioned. Increased holiday shopping. Some might say now, okay, with lockdowns, especially here in Germany now taking place, but I think around the globe being a big topic, probably this year will be a slightly different here. If that's the real driver behind the Santa Claus Rally, then it will probably not take place this year because there's no real holiday shopping. On the other hand, we have to say most of shopping is likely to be done online. So not really sure whether this is really a driver. It's also optimism fueled by the holiday spirit. So it's that's sad. It's, I mean, some might laugh now and look at this and really say, oh, well, are you serious? So just because people are happy about Santa Claus and feel, especially adults, grown-ups, traders, or investors might be reminded of some nice situations during their childhood. That's why they start to buy stocks. I mean, what kind of argument is that to bring it forward here? But you have to see it from this perspective. It's psychologically, I think that makes definitely sense. Someone who is willing to or not willing to, but someone who's optimistic about the future, who's calming down, whose fear disappears, not necessarily, but who is probably saying, well, why not just spend some dollars on this and that investment, probably. I think this is definitely something, a positive bias from psychological standpoint, something which we definitely should take into account. And beside that, there's also something, this is probably a more technical thing, but also something you have to take into account, the so-called window dressing taking place into the yearly close, probably especially into the yearly close. So institutional investors settling their books, in fact. And what they usually do within this time span is they are buying companies or stocks from companies which perform quite well over the course of the last 12 months, and very roughly speaking, but reduce the exposure to stocks which haven't performed very well at all. That said, I mean, and especially given the weight of big tech companies, high beta stocks in the S&P 500, for example, Amazon, Apple, Google, Netflix, Microsoft, Facebook. These are this call it the Fangman complex. Given their weight in the S&P 500, this could definitely drive, if especially when looking at the performance of the recent months and post COVID-19 and the lockdown in March, and after the sharp pullback we've seen in March, especially, and how we recovered these losses and then pushed to new all-time highs. I mean, certainly we can now argue, well, that's mainly due to the fat liquidity and all this. But all in all, however you argue that, it's a given or it's a fact that these companies have seen some serious run-ups over the last months, have performed extraordinarily well. And if I was a fund manager now who has to sell his fund, I want to present my exposure based on the performance given the last 12 months, the best performers. And in this context, it's the big tech companies you present to your clients and say, hey, look here, these are the companies I have currently in my portfolio. And that's why I'm worth your investment. I'm worth your money. Put it in my fund because I invested with the winners. And it's likely that these winners will also continue to win in the upcoming 12 months in the next year. That might be the case, that might not be the case, but at the end of the day, that's also one aspect we should take into account, and which is probably driving the Santa Claus Rally here. But the thing is, whatever the reason is for the Santa Claus Rally, there is data which goes back into the 1960s, and which clearly suggests that there is such a thing as a Santa Claus Rally. So as I already pointed out, the final 5 trading days of December. So as I already said, in case of the US equity markets, it's the 26th, 27th, 28th, 29th, and 30th, so last 5. And then the first 2 of January, these days show a cumulative return in the S&P 500 of 1.4% since 1969. So, and here in this context, what I have now is a chart from a source called the Stock Traders Almanac. Let me just go over here. Oh, I'm sorry. Oh, that's not so good. 1 second. Let me just see if I can exit. Yes, I can. Perfect. So now here's the website. So this is the Stock Traders Almanac. If you're interested in that, I highly recommend reading here through this website. But we want to now go back to here to our presentation, and let me just share this. Here's the graphic again. Let me just share this here in the chat box. Stock Traders Almanac. So for further information, for those watching this now on YouTube, the recording, check out the description box. So you find this link in the description box. And so what does this chart here show us? It shows the Santa Claus Rally in the past 10 years. So you can see we've taken out 2019. It's not included here, but you can check out yourself that in 2019 there has also been this positive development over this time span. In fact, I haven't checked out the numbers, but I can assure you there was a push higher. And what you can see is there's a clear positive tendency going back to the great financial crisis in 2008. In fact, even after such a horrible year, you can see that there has been a positive return of over 7% in these 7 days. So the last 5 trading days of December, and then the first 2 in January. And you can clearly see, only taking out 2014 and 2015, that this has been a quite solid approach. In fact, I think it perfectly points out that there has been a positive performance over this time span, and these are only the last 12 years. So it's a window which opens, and you might now argue about the reasons why this is, but it's similar to what I just pointed out last week with the seasonal patterns which occur in commodities. At first glance, Certainly they have to make sense, but even if they don't make sense at all, at first glance, it might be because we are not as well informed as we think. So as I pointed out last week, for example, if you want to create your own seasonal chart, you can do this also with stocks, for example, and there might be seasonal windows which open and close over certain time spans. And one of the reasons could be that there is, for example, some tax reasons, whatever, some adjustments taking place within the company every year around the same time, and thus resulting in a repeatable pattern, which could then potentially being traded profitably. The same is true for the Santa Claus Rally in this context, and that there is some repeatable pattern which can obviously be traded profitably, even if you take out this sharp rise in 2008. You will certainly see that there has been a positive, overall positive return here in this over this period from 2009 up to 2019, and this will likely return. It's not that it's no brainer, but when looking here at last 10 years, you can see in 8 of these 10 years, 80% of the cases, so that's a high probability trade, in fact, if you want to put it that way, you have seen a repeatable pattern which could potentially be traded profitably. And so now what we want to do is we want to dig deeper a little into the Santa Claus Rally and the numbers behind this. So we call the Santa Claus Rally, as I already pointed out now several times, and as I already mentioned, for example, last week in our seasonal webinar, a seasonal commodity trading webinar, we call the Santa Claus Rally a so-called seasonality. So the Stock Traders Almanac we already referred to points out that since 1969, the Santa Claus Rally saw positive returns on average from 1.4%, and it has been positive these days. We pointed out last 5 days of December and the first 2 in January, in 34 from 45 between 1969 and 2014. So what I just point out here, so they didn't update their numbers, but is they're looking at the numbers between 1969 to 2014. If we go back here, you can see that here there's now they have to update it to 49 years if they look at this up to 2018, and they will see that there is now a probability of 37 out of 49 in this case. 37 out of 49. Let me just see, what does this mean? 37 out of 49. So the hit rate is over 70%, 75.5%. And again, if you now look here at the average performance, you will certainly find out that the average performance is again for these 4 years here in the range around 1.4%. So it hasn't dramatically changed, even though we look here, we end this period we look at 2014, but in fact, the last 4 or 5 years have underlined the significance of the numbers which were pointed out here within this window. So now let's again have a look again at the reasons for this seasonality, for the Santa Claus seasonality, why it might occur. And now I want to focus really on the more statistical things, respectively more technical things, like the window dressing approach, which I already mentioned and pointed out several minutes ago, with sell bad performing stocks, buy good performing ones. And in more depth, fund managers then tend to invest in value stocks into the yearly close, resulting in value outperforming growth, which is this is in fact the opposite of what I just presented. So this rotation might take place now into this yearly close too, because there has been a big discrepancy between a growth and value, and a growth has massively outperformed value, and the rotation back into value probably has started with the first vaccine headlines, which we saw on the 9th of November, around 1 month ago. But the thing is that I personally think that might rather probably it will change in the near term. But I have somehow the impression that I think that especially now, and with the outlook of a very, very dovish Fed in the months to come, with all the liquidity being provided, especially when it comes now to the appointment from President-elect Biden, that he appoints Church as Janet Yellen, the former Fed chairwoman, as the Treasury U.S. Treasury head of fine. Yeah, so replacing Steve Mnuchin, the name, yeah, Treasury Department appointee. That this is probably also a clear sign that the time of cheap liquidity and very dovish approach being taken from the Fed, especially, that this should be expected to take place over an extended period of time in the future. In fact, I can really imagine that up to 2023, probably 24, 25, there will be no rate hikes at all. There will be no mentioning of rate hikes. And usually this is an environment which leaves growth stocks performing extraordinarily well. But all in all, we should just probably cut it down to window dressing. And that's one of the main drivers. It's also something which we knew as the so-called January effect. So it's an anticipation of rising stock prices in January, which is also, by the way, another well-known seasonality, and which could be measured and can be measured, in fact, and where we could see that this anticipation is probably already taking place from the Santa Claus Rally. So anticipating, due to the January effect, that there will be a rise in equity prices, which then means that you start to build your position, anticipating such a move already early in the year, probably already in the last days of the year before, in fact. And this is two potential and I think valid reasons to take into account here when it comes to explain this seasonal window, which opens here around Santa Claus, or in the days after Santa Claus, in fact. So now, oh, I'm sorry, this is a double, by the way. 1 second. So now let's have a look here at the pros and the cons of a Santa Claus Rally, in fact. So first of all, a clear pro, as you may have seen now, not just in this webinar, but also in the webinar last week when we started with having a look here at seasonalities. Seasonal patterns just happen. And we've seen this in the earlier webinar. By the way, 1 second, please. I just have to. So seasonal patterns, they just happen. They are there. They should make sense. It shouldn't just come out of nowhere. But as I already pointed out, when looking, for example, at seasonal windows in stocks taking place, that might not be due to, I don't know, a company which is selling wheat, for example, that it has something to do with summer, respectively, the harvesting period and all this. So there might be other reasons, for example, especially when it comes to financial companies, when it comes to tax-related questions, tax-related reasons, which might be the reason for the seasonality taking place. So seasonal patterns, make long thing short, seasonal patterns just happen. And again, as I already pointed out last week, having these on your agenda, agenda from a trading perspective, makes sense. Also from a technical perspective, since it could result in significantly increasing the risk reward for your trades. So put it differently, I mean, there's plenty of reasons. Probably you have gold on your agenda right now due to elevated volatility, not just for fundamental and technical reasons, but also because of volatility reasons, and because there's high volatility in gold taking place right now. There's several reasons, also from a technical perspective, probably, and also with rising yields from a fundamental perspective, if you want to take it from that angle. What you can see in case of gold is still that gold is performing quite well over the course of the month of December, and it will likely perform well due to the positive seasonality or seasonal window in which gold finds itself currently. So knowing that, bullish seasonal window in which gold currently performs leaves me, even if I come to a bearish conclusion based on my technical analysis, I'm sorry, technical analysis. If you look at a daily chart, for example, you will see everything taking place below 1,900 USD should be taken very carefully. Respectively, probably bears consider themselves to be in charge of the price action below 1,900 USD. But will I trade aggressively below that level on the short side? That might be the case if we'd be somewhere within the year, somewhere, let's say in, I don't know, summer probably. But right now, we are in a classic bullish seasonal window, which means nothing more than if I take a short trade in gold, um, I'd take it with, I'd be really careful in terms of taking it due to the fact that we are in a bullish seasonal window right now. And that the likelihood is high that there will be, for whatever reason, a stronger demand for gold in the weeks to come, which will make it quite difficult for my short position to play out. So having this taking this into account here leaves me with a chance to increase my overall profitability. And that doesn't mean I shouldn't take short trades, but it means that I take them with more, being more careful by taking them, and probably reduce the position size, for example. And especially experienced active traders here can obviously massively profit from such seasonalities like Santa Claus, combining it with technical analysis, position sizing, and active stop management. So, which means nothing more than you might probably take a long engagement over the course of the last trading days of the year, and have a chance, given your expertise, given your not just feeling for the market, but also the possibility to see pattern developing, for example, a structure you want to trade here. You can use the knowledge around the Santa Claus Rally and this phenomenon, this seasonality taking place, to probably increase your profitability by also trading it more aggressively, probably. That, again, it needs experience in this context, but all in all, it gives you a very good chance to increase your overall profitability with your trading. On the other hand, inexperienced traders, but also classic so-called buy and hold investors, so long-term investors, they probably have difficulties to profit from seasonal patterns in general, but probably especially from the Santa Claus Rally, since if they are not really, let's call it, keen about or actively managing about their risk and money management, respectively, actively managing their risk within their trading due to their higher level of activity in their trading. If that's the case, then you probably won't profit as much from a Santa Claus Rally, and probably it's even probably for some it might be also counterproductive, let's call it, to take this into account, but probably probably ignore it just as part. For an experienced trader, if you consider yourself an experienced trader, if you have a deeper knowledge about the market structure, this can really be useful to increase your overall profitability. In case of an inexperienced trader, he might probably be taken away from trades he probably should take, and he's not taken due to the fear of being on the wrong side of seasonality in this context. Probably put it that way. I think that's a fair way to put it. But still, for such inexperienced traders, but also for buy and hold investors, seasonal pattern like the Santa Claus Rally might be of interest in terms of understanding one potential driver for current price action in the market. So if you look at the market right now and you don't really understand, for example, especially during this time span, you don't really understand why is the market drifting higher. It's of interest for you. You don't plan to actively trade it, but you really want to understand what's driving the market currently. Then knowing such seasonal seasonalities in general, but seasonal windows opening and closing, that might be one potential driver, especially when looking at it from a window dressing perspective, which is not just playing an important role into the yearly close, but it's also playing an important role into quarterly closes, for example. Could also result then here in this context, then we could also extend this to Forex markets and rebalancing taking place among portfolio managers, for example, who are investing for their clients in countries with another currency or underlying currency in which the investors don't want to invest but want to see their exposure being hedged. For example, let's take a European investor who wants to pay his bills, easily speaking, in euros, and he still invests with a portfolio manager who plays the US equity markets, for example. So if I'm buying Apple shares, Amazon, and everything, well, certainly I will have exposure in US dollar, which means I then have to buy a euro and sell my US dollar in the the resulting amount I have on my book, which could then result in, for example, swings into the monthly close taking place, not just into the yearly close where the Santa Claus Rally comes into play, and window dressing, but also in the quarterly close or in the monthly close, which could come of interest here. But don't let us overcomplicate things. So all in all, it's a very interesting pattern. If you trade it or not, we've seen that you can trade it profitably. There's a reoccurring pattern, which is of interest for many, especially active and experienced traders, and you can profit from that. Still, it's something which is, first of all, also for inexperienced traders of interest due to their understanding of the market, what's driving currently prices. So let's sum this up. So the Santa Claus Rally refers to a seasonal pattern which usually occurs over the last 5 trading days of the year in December and the first 2 trading days of January. And between 1969 and 2014, this seasonal pattern netted a cumulative return of 1.4%. This hasn't changed over the course of, or between 2015 to 2019. Despite the fact that the probability, the hit rate increased, in fact, over this time span slightly, but still. And over the course of the last 5 years, you can see it here, the pattern 2015 to 2019, this pattern still performs solid, averaged a profit of around 0.8% per year. Again, this doesn't change much in terms of the longer period here, 1969 to 2014. Trading the Santa Claus Rally is mainly for active traders, experienced traders who are combining technical analysis, position sizing, and also active stop management, while inexperienced traders and buy and hold investors, especially, then probably can't really actively profit from seasonal patterns like the Santa Claus Rally. This is especially true for buy and hold investors, even though you might say, well, buy and hold is great because if you buy something and hold it over this period, then you're naturally profiting from this Santa Claus Rally. While this bullet point here mainly targets, in fact, inexperienced traders who have trouble to profit from that, but still could understand at least what's currently driving the market here. And so don't forget to join us next time. Okay, let me just check here. No, everything's fine. So as I already pointed out, in terms of an example, again, so the dates are clear. It's starting from the 26th of December. That means you start, in fact, to buy the S&P market on this day, and you hold the position over the course of the next 5 trading days, in fact. So you open the position since the 26th is a Saturday. You open the position, in fact, then on Monday, the 28th, and then you hold the position till the next week, Monday. In fact, since the 1st of January is a Friday, the 2nd of January, when you usually close, or the 3rd in this case, the 3rd of January, when you close the position, it's the second trading day, usually, under normal conditions. You will have to hold it over the weekend, and then you close it on the opening price of the 4th of January 2021. And have you done this back to the 1960s, last century? You've netted on average 1.4%. This is just hypothetical, so it's not indicative of future results or something like that. So please don't misunderstand that. But it's one way to trade it, in fact, in the current environment. And if you're interested, and you certainly are, if we return to this webinar, then in 2021, we can certainly have a look here on how this Santa Claus Rally would have performed and directly view it up in the chart. No question about that. Yeah, don't forget to join us next time. So on Monday, Paul will have a look at the developments in US equity markets, especially after the US presidential election, which took place in November, on the 3rd of November. And he will answer the question, who were the winners and who were the losers? How did the global markets react? I think everyone remembers that it was quite a roller coaster. And then he answers the questions if there are any new trends emerging that offer us opportunity based on what happened after the presidential election. Paul will be here on Monday, the 14th of December, 2 p.m. London time. And if you're here right now and in the live event, then you don't need to do anything, but just wait for the webinar link to appear in your inbox. It will be directly sent to your inbox. While if you watch this on YouTube, then head over to admiralmarkets.com to the educations tab, and there, or webinars, and there the trading spotlight window opens, and there you can register for free for this webinar. If you're also watching this on YouTube, if you enjoyed what you just saw, please leave a thumb up here. Please also leave a comment in the chat box below. I'd be happy to answer your questions if there might be any. And this is the website. So admiralmarkets.com for further information around Admiral Markets and the webinars. Here are the contact details from Admiral Markets. And here is the risk disclaimer. Fully regulated broker. That's it from my end. So all the best. We talk again next week with our last webinar in 2020, in fact. And just let me just check what's the topic of next week. Oh yeah, that's very interesting. The top 5, my personal top 5 risk and money management tips and tricks for your Forex trading. Might be of interest for many of you. So I look forward to it. Again, have a nice weekend first. Stay safe. See you next week. Look forward to it. See you and bye.